Somewhere on Wall Street right now, someone knows something you don't. Not a guess, not an analysis, not a model built from publicly available data that took a team of analysts 6 months to construct. A fact. A specific, verified, non-public fact about a company whose stock is trading right now on an exchange where you and every other retail investor are operating entirely blind. They know the merger is happening before it is announced. They know the earnings are going to miss before the report is filed. They know the FDA is going to reject the drug before the press release goes out. And in the hours or days between when they learned that fact and when the rest of the world finds out, they are positioned to make a return that no amount of research, skill, or discipline could have produced through legitimate means. This is insider trading. And it is not a relic of a less regulated era. It is not a problem that enforcement has solved. It is happening right now, in the market you participate in, at a scale that the public prosecution record dramatically understates. The question is not whether it exists. The question is how it works, who does it, how they get caught, and what it actually costs the people who never get access to the information in the first place. That last part is the part nobody explains clearly enough. Part 1.
What it actually is. The legal definition of insider trading is specific, but the concept is simple. Insider trading occurs when someone trades a security, a stock, an option, a bond, based on material, non-public information. 3 words in that definition carry all the weight. Material means the information would matter to an investor's decision. Not gossip, not rumor. Information that, if known publicly, would move the price of the security in a predictable direction. A pending acquisition is material. An upcoming earnings miss is material. A CEO's undisclosed health crisis is material. The fact that the company cafeteria changed its lunch menu is not material. Non-public means the information has not been disclosed to the market. It exists inside a company, inside a boardroom, inside a law firm, inside an investment bank. But it has not been released through any channel that gives all investors equal access to it. Trading means acting on that information in any way that creates a financial advantage. Buying before good news, selling before bad news. Purchasing options that will pay off when the information becomes public and the price moves accordingly. The combination of those 3 elements is the crime. And the reason it is a crime is both legal and philosophical. The legal reason is that it violates SEC Rule 10b-5, which prohibits fraud and deception in connection with the
Purchase or sale of securities. The philosophical reason is that markets only function as mechanisms for capital allocation if participants are operating on a level enough playing field that price reflects reality, rather than the information advantage of the most connected participants. When insiders trade on private information, the price you see on your screen is not a reflection of what the market knows. It is a reflection of what the market knows minus what the insiders know. You are trading against people who are playing with their cards face up, while yours face down. That is not a market. That is a transfer. The tipper and the tippee. One of the most important and least understood aspects of insider trading law is that you do not have to be an insider to commit the crime. The law recognizes 2 categories. The tipper, the person who possesses the material non-public information and passes it to someone else, and the tippee, the person who receives the information and trades on it. Both are liable under certain conditions.
The tipper must have received a personal benefit from sharing the information. This benefit does not have to be financial. It can be reputational. It can be the benefit of maintaining a friendship or a business relationship. It can be a gift. Sharing valuable information with a close friend or family member qualifies as receiving the personal benefit of that relationship. The tippee must know or have reason to know that the information came from a breach of duty. This is where many insider trading cases become legally complex. If someone tells you over dinner that a company they work for is about to be acquired, and you trade on that information, your liability depends on whether you knew or should have known that the person sharing the information was breaching a duty by sharing it. This tipper-tippee framework created one of the most consequential insider trading cases in history. The case involved a network of hedge funds, expert consultants, corporate employees, and traders so sophisticated and so well insulated from each other that investigators spent years mapping the connections before making a single arrest. That case was Rajaratnam and the Galleon Group, and it changed insider trading enforcement permanently. The Galleon case, how the network worked.
Rajaratnam founded the Galleon Group in 1997. By 2009, it was one of the largest hedge funds in the world, managing approximately $7 billion in assets. Rajaratnam was celebrated as one of the best stock pickers in the business. His returns were consistently strong. His analysis was considered exceptional. His analysis was not exceptional. His information network was. Rajaratnam had built over years of careful relationship cultivation a network of corporate insiders, consultants, and analysts who fed him material, non-public information about companies before market-moving events. Earnings, mergers, drug approvals, analyst rating changes. The information arrived through phone calls, meetings, and intermediaries in a web complex enough that no single transaction was obviously connected to any single source. The FBI and SEC dismantled the network using a tool that had never been used in a securities fraud case before: a wiretap. Federal investigators recorded Rajaratnam's phone calls over months. What they captured was explicit. Conversations in which corporate insiders described upcoming earnings results, pending deals, and confidential business information, while Rajaratnam took notes and placed trades. The recordings removed any ambiguity about intent that might have existed in a case built purely on trading patterns. In 2011, Rajaratnam was convicted on 14 counts of securities fraud and conspiracy. He was sentenced to 11 years in federal prison, the longest sentence ever imposed for insider trading at that time. The investigation resulted in over 50 convictions across the network. The Galleon case demonstrated two things clearly. First, sophisticated insider trading at the highest levels of finance is not opportunistic. It is systematic. It is built and maintained deliberately as a competitive advantage. Second, when investigators have access to communications, rather than just trading records, the crime becomes extremely difficult to defend. The Martha Stewart case: why cover-ups cost more than crimes. In December 2001, Martha Stewart sold approximately 3,900 shares of Imclone Systems stock, one day before the FDA announced it was rejecting the company's cancer drug application. The stock dropped 16% on the announcement. Stewart avoided a loss of approximately $45,000. $45,000. That is the amount the most famous insider trading case in American history involved. Stewart did not go to prison for insider trading. The insider trading charge was dropped. She went to prison for obstruction of justice and making false statements to federal investigators. She lied about why she sold the stock. She constructed a cover story, a standing order to sell if the stock dropped below $60, that investigators determined was fabricated after the fact. The cover-up was worse
than the crime. The original trade would have been difficult to prosecute. The lies about the trade were not. Stewart served 5 months in federal prison and 5 months of home confinement. Her company, Martha Stewart Living Omnimedia, lost hundreds of millions of dollars in market value during the legal proceedings. A legal defense that could have argued the original trade on its merits became impossible the moment false statements were made to investigators. The Stewart case is studied not primarily as an insider trading case, but as a forensic demonstration of what the cover-up costs. Investigators frequently find the original violation manageable.
Obstruction? Catastrophic. If you lie to federal investigators, the lie becomes the case. The original fact underneath the lie becomes almost irrelevant. This pattern repeats across almost every high-profile financial crime prosecution. The initial violation creates exposure. The human instinct to minimize that exposure through concealment creates criminal liability that is far easier to prove and far more seriously punished. The mechanics. How trades are actually hidden. Understanding how insider trading is executed requires understanding how sophisticated participants attempt to conceal it. The most obvious method, buying stock in your own name the day before a major announcement, is also the one most likely to result in prosecution. The SEC's surveillance systems flag unusual trading activity around corporate events. A large purchase of call options on a company that announces a merger 3 days later is not invisible. It is a data point that generates an inquiry. Sophisticated insider traders use several layers of distance between the information and the trade. The first layer is the intermediary. Rather than trading personally, the insider tips a friend, a family member, or a trusted contact who places the trade. The insider maintains distance from the transaction. The tippee assumes the risk. The benefit flows back through the relationship rather than through a direct payment. The second layer is the instrument. Options are frequently preferred over stock purchases because they offer leverage. A small investment can produce a large return if the underlying stock moves significantly. They are also more anonymous at the point of purchase. A single options contract represents 100 shares and costs a fraction of the underlying stock price. The position can be built quickly and quietly. The third layer is jurisdiction. Trades placed through offshore accounts, foreign brokers, or entities in jurisdictions with strong banking secrecy laws create additional barriers to regulatory investigation. The SEC has jurisdiction over trades made in U.S. markets, but obtaining records from foreign financial institutions requires legal processes that take months or years. The fourth layer is timing. Insider traders rarely act immediately on information. Acting immediately creates a direct temporal link between the receipt of information and the trade. Experienced operators wait, building positions gradually over days or weeks in ways that blend into normal trading patterns. None of these layers make the crime impossible to detect. They make it harder. And harder is frequently sufficient when regulatory resources are limited and the volume of trading activity is enormous. How the SEC actually catches them. The SEC's Enforcement Division uses a combination of surveillance technology, financial forensics, and human intelligence to identify and prosecute insider trading. The surveillance component is largely automated. The SEC and FINRA, the Financial Industry Regulatory Authority, maintain systems that monitor trading activity across all U.S. markets in real time. These systems flag anomalies, unusual volume, unusual options activity, unusual timing relative to corporate announcements, and generate alerts that human investigators then review. The alert is not evidence, it is a starting point. An investigator who receives an alert begins pulling trading records, identifying the accounts behind the activity, mapping relationships between traders and corporate insiders, and looking for the connection that transforms a suspicious pattern into a provable case.
The financial forensics component involves following the money. Subpoenas to brokers, banks, and transfer agents identify who owns the accounts, who funded them, and where the proceeds went. Digital financial records are extraordinarily difficult to fully erase. Every transaction leaves a trail across multiple institutions. Investigators with time and legal authority can reconstruct a complete financial picture from fragments spread across dozens of accounts. The human intelligence component is the one that produces the most significant cases. Cooperating witnesses, insiders who have been caught and agree to provide information about the broader network in exchange for reduced charges, are the most powerful tool available to prosecutors. The Galleon investigation produced over 50 convictions, largely because early defendants cooperated and provided information about participants further up the network.
This is the structural vulnerability of any insider trading network. It is only as secure as its least committed member. And when investigators offer that member a choice between cooperation and prosecution, the network begins to collapse inward. The cost to ordinary investors. The prosecution record of insider trading focuses necessarily on the perpetrators. The victims are diffuse, anonymous, and individually small. But the aggregate cost is significant and largely unquantified. When an insider buys stock before a positive announcement, they are buying from someone who is selling. That seller, who may be an individual investor rebalancing a portfolio, an institution meeting a redemption, or a fund following a systematic strategy, is selling at a price that does not reflect information the buyer possesses. They are selling too cheaply. The difference between the price they received and the price they would have received if the information had been public is the direct cost of the insider's advantage. Across millions of transactions involving insider information over decades, this transfer from uninformed sellers to informed buyers is substantial. Academic research has consistently found that stocks subject to insider trading exhibit abnormal price movements in the days before major announcements. Movements that cannot be explained by public information and that benefit the informed traders at the direct expense of the uninformed ones. The indirect cost is harder to quantify, but potentially larger. Markets that are perceived as unfair attract less participation. Investors who believe the game is rigged reduce their exposure. Capital that would otherwise flow into productive investment stays on the sidelines. The efficiency of capital allocation, the core function that makes financial markets useful to the broader economy, degrades in proportion to the degree that price reflects private advantage rather than public information. This is why insider trading enforcement is not a niche regulatory concern. It is a structural requirement for functional markets. The legitimacy of the entire system depends on the perception that participants are competing on the basis of analysis and judgment rather than access and relationship. When that perception fails, the system loses something that enforcement cannot restore. It loses trust. The cases that never get prosecuted. Here is the part of the insider trading story that the enforcement record does not capture. The cases that result in conviction represent a fraction of the insider trading that occurs. Academic studies using statistical methods to identify abnormal pre-announcement trading consistently find patterns that suggest information leakage far more frequently than prosecution rates would imply. A 2014 study published in the Journal of Financial Economics examined trading in options markets before merger announcements and found evidence of informed trading in approximately 25% of deals. The prosecution rate for insider trading in merger cases during the same period was a fraction of that figure. The gap between the statistical evidence of information leakage and the prosecution record reflects several realities. Surveillance systems generate far more alerts than investigators can pursue. Complex cases involving offshore accounts and multiple intermediaries require resources that exceed what enforcement agencies can commit to every potential violation. And proving insider trading beyond a reasonable doubt requires establishing not just that someone had information and traded, but that the specific information they had was material, non-public, and obtained through a breach of duty. The evidentiary standard is high. The investigative resource constraint is real.
The result is a prosecution record that captures the cases where the trail is clear and the evidence is strong, while the broader landscape of information advantage remains largely unaddressed. This is not an argument that enforcement is failing. It is an observation that the visible enforcement record significantly understates the actual prevalence of trading on private information in financial markets. The market you participate in is not a level playing field. It has never been a perfectly level playing field. The question for any investor is not how to access information that insiders have. That path leads to prosecution. The question is how to build an approach that generates returns that do not depend on an advantage you will never have. The answer
to that question is the same one it has always been. Time in the market, diversification, low costs, discipline through volatility. These are not exciting answers. They are the answers that work for participants who are operating on the right side of the law, in a market where some participants are not. The insider knows what is going to happen next. You know something they do not. How to wait.